All right, so today we have Chirag Yagnik. He is the research and engineering co-founder at Arta Finance, which has the tagline, or at least this is copy I grabbed from their website, because financial superpowers shouldn't belong to just the ultra wealthy. And also, Arta gets you access to financial opportunities that help you plan and enjoy your financial future like the very wealthy do, but without the complexity and high fees. They call this the digital family office. So, with that long winded introduction, welcome to the Data Exchange podcast, Chirag.
Ben, thanks for having me here today. Excited to talk
And,
about
and for our audience, I guess it's responsible for us to have a disclosure up front that the content in this episode is informational only. You should not construe any information here as legal, financial, or other advice.
This is a great podcast, Ben. You've already done my job for me.
Yeah.
Thank you.
Yes. And then, all right. So I think, so broadly speaking, our conversation will be the application of AI and machine learning in finance, and specifically generative AI. But of course, we have to put what Chirag is doing in context up front. So, baby Chirag, describe to the audience. I guess I kind of described what Arta is, a digital family office. But let's see. So, why is the kind of research that you guys do in Arta different from what Google or Facebook does, or Netflix, or Spotify? You know, the recommenders, or other machine learning algorithms that they do. What makes what you are doing? I guess broadly speaking, you would call it portfolio or asset management.
Yeah.
Why is this different?
Yeah, great question, Ben. So just to level set, we're in the wealth management space, right? And the genesis of Arta, as you described it, right, is, me and my co-founders were, at Google, some of them, a broader team, ton of exposure at big tech companies. And what all of us saw was that, founders of those companies or senior executives of those companies had financial superpowers, right? In the examples are they had a line of credit, right? They could borrow against their stock portfolio, right? They had access to alternative investments, right? They had access to state-of-the-art estate planning, right? And if you think about it, these are all the different verticals, in the financial sector, right? Another one is insurance, right? Insurance is a great tool you can use, for transfer of wealth and, for tax efficiencies. So if you think about it holistically, like these individuals have these superpowers, and not only that, they had advisors that can help them integrate across all of these and globally optimize their portfolios, right? So it's not just about investing in public markets, and trying to outperform S&P. Typically, that's what a hedge fund would do, right? What we're trying to do is effectively look across the spectrum of like, what are the risk factors a user is exposed to? So for someone who's working in tech, they're going to be predominantly exposed to, the company that they're working for. And, if you own a home in the Bay Area, you're also exposed to tech, right? Because when tech goes down, real estate values in the Bay Area are going to drop, right? So it's looking at all the risk factors of a user and effectively crafting a holistic plan that is appropriate for them. And taxes also factor into all of this, right? It's not just about price prediction and like trying to outperform the market. Oftentimes it's more prudent to actually look at tax, returns net of taxes. And that's where all of these other verticals actually can make a very, very material difference. So that's, in a nutshell, that's what we're trying to do. And sort of diving a level deeper, well, how is machine learning different in this area, right? I'd say there's a few key differences between machine learning in this area and others. One being non-stationary and the adversarial nature of the markets, right? And what do I mean by that, right? Which is, typically if you have I'm going to take a very simple example. If you build a classifier for animals, once you train it, and once you're happy with the performance of it, until animal species evolve, you don't actually need to change the model, evolve that model, right? This is not the case for financial models because market dynamics are constantly changing. And in some ways, you have other intelligent actors in the ecosystem, right? So as soon as you start exploiting some information that's valuable, others are going to start reacting to your actions in the ecosystem, right? So you constantly have to evolve that. So that's number one, right? Number two, the data sets are quite sparse. If you're just looking at the prices, right? Ultimately, everything you can say everything boils down to prices, because that is how you enter a position and exit a position, right? You have 250 trading days in a year in the US markets, right? So not a whole lot of data. You can bring a lot of unstructured data and you can create the volume, but ultimately your interaction points are going to boil down to price at which you're going to get in and price at which you're going to get out. And that critical data point and sort of similar macroeconomic data points that you get as a time series, not only are they sparse, they suffer from the three evils, right? In data science, we call it heteroscedasticity, autocorrelation, multicollinearity, right? So they're not independent samples. And so that makes it really hard to extract value out of them, right? So, so the question is, how do you then, form the machine learning problem the right way so you can extract the most value out of the data without over relying on what, the specific path the markets have taken in the past. And the last one is it's actually more of an art than a science. Is oftentimes, when we talk about financial markets, the immediate reaction is, oh, can we predict the markets, right? Well, there is value in trying to do so. I think there are other avenues to actually generate a better financial return, right? Like what I talked about earlier, right? If someone's portfolio is heavily concentrated in one stock, I would argue that they shouldn't be worrying about beating the market. They should worry about diversifying and taking the risk that they were willing to take in that single equity in a more diversified portfolio. And that will help them generate a higher return much more easily than trying to outperform the market. The other example is if you have 20% of your savings, in a checking account, which is earning you 0%, and then you try and beat the market with, whatever 10, 20, 30% of the portfolio that's invested, you have many easier avenues to actually outperform the market by investing that the 20% slice in the savings into slightly riskier assets.
So I have many questions based on what you said, but
Yeah.
basically you opened by summarizing why I left the hedge fund industry, because it's very hard.
Yeah.
As a quant, it's fun, but just when you have some success, your success evaporates.
That's true.
And it's a very competitive market with a lot of smart people. Basically, almost all the people that you're competing with are looking at the same things that you are.
That's right.
Now, for a long time, Chirag, there was, people were talking about, well, now that we have access to big data science, we can manufacture alternative signals, and maybe these alternative signals become our secret sauce. And that hasn't really panned out. And I think, to your point, whatever signals you manufacture will suffer from similar challenges, sparsity and multicollinearity, right? So autocorrelation and so on and so forth. One question, intraday prices. So the high frequency trading guys obviously have more than 250 observations per year, right?
Absolutely. In fact, that, my prior life before Google was that, right? So I led a desk, just for more context, I led a desk that was one of the largest traders in the US equity markets. We traded very, very liquid instruments like SPY, QQQs, index ETFs. There were times when our trading volume was anywhere between 5 and 30% of the entire market. So deeply familiar with that space.
So they have a lot more observations than 250 a year. So
True.
Is their situation any different?
There is a difference, but their objectives are quite different than a typical investor's objectives, right? So, and there's other constraints that come with being in that space, right? So typically in the intraday, high frequency trading, the expectations for returns are significantly higher. And the reason for that is you can think of high frequency traders, like one way to think of them is they are actually helping the price discovery process, right? As soon as new information is coming in, they're attempting to rationalize, okay, how does this affect the valuations in the market, be it specific securities or indices, right? If it's macro factors that are changing. And they're the first ones to act on that, right? And so their profitability hinges on how smart are they in evaluating these incoming signals, and B, how much liquidity are they able to interact with, right, to profitably make those trades, right? If markets were always efficient, you can argue that there's no trades to be made because everyone is agreeing on the view, no one is buying and no one is selling at different prices, right? While they're very profitable if you get them right, there's also a scaling. You can only scale them so far, right? Because there's only so much opportunity to do basically a pure arbitrage or almost a pure arbitrage in the market, after which there is no more capacity. So oftentimes, we found that once we started becoming a significant percentage of the market, that we couldn't scale any further, even though signals were clean. We had our good inferences from our models. There's only so many trades you can do in a day, and so that's where the biggest sort of limitation in that space is how far you can scale those strategies.
So what about what do you say to people who claim they have some alternative signals from satellite images or whatever, right? So
No, they work. They absolutely work, right? So there's trading desks that are solely focused on predicting the average temperature over the next week or the next month, right? And effectively, if you can do that, you have a massive edge in the energy markets, right? You can trade energy futures. There's a whole bunch of complexes you can trade. It's also true for electricity futures, right? If you know that it's going to be colder in a particular region, there's spikes in electricity usage. But again, they're all going to suffer from the same capacity issues, where once you make a few profitable trades, there are no more people to trade with against you, right? Because everyone is kind of looking at new information, adjusting to it. And so the key there is to be constantly coming up with new signals that allow you to stay on top, right? Every signal is going to have a decay. And after a while, you're going to have to come up with new ideas to continue to stay on top.
And so do you think, Chirag, that AI and generative AI, one of the key places where they will make a difference is in this new signal generation?
I think there certainly can be, use cases for that, and there clearly are, right? Like if you think about, traditionally, the way value funds operated is by analyzing companies from a very fundamental level, right? What are their earnings? What does their balance sheet look like? What is their debt to income ratio? All those basic fundamental stats, right? And they would pour through, executive, talks about, the outlook for the company, and so you can imagine large parts of that workflow can be automated, right? What that enables now is, smaller teams can actually go after the same problems that, typically you would have to hire tens of analysts, right, to go through these data sets and to, extract insights from them. So certainly, I think in some ways, this is going to democratize, extraction of, good signals and alpha. So certainly, I think that's one way to look at it. The other way to look at it, at least this is relevant for us at Arta, right, is alpha generation is in service to just purely profitable trading, right? That's one way to look at it. But if you think about it, let's step back and look at what is the price prediction horizon, right? Because that will change the approach that we use. If you look at intraday, ultra high frequency or high frequency, you can almost say macro factors actually don't matter, right? Unless you're doing event-driven trading on numbers on economic releases, that's a whole different thing. But the typical intraday, stat art or market making, macro factors actually don't matter that much because you're getting in and out of positions in microseconds, milliseconds, right? So predictions there are relatively easier than predicting something a week, 2 weeks, a month, a year out, right? Now let's look at the very long time scale. I would argue that predictions there are also relatively easier. If you look at decades, decades on out, right, 10, 20, 30 years from now, a case can be made that markets are on an uptrending trajectory and that we have hundreds of years of data for that, right? There's going to be blips, but overall that trajectory is up. And you can have sort of higher confidence on a 10, 20, 30-year timescale that markets are going to be up. It's in the middle where the complexities actually grow exponentially, right? And a good example of this is think about COVID, right? If someone's investing with a 3, 4, 5-year horizon and bam, COVID hits, right? Who could have predicted COVID in their models, right? Even if, like, let's grant that someone could predict that COVID was going to happen at the scale at which it happened. Then can they time the market, right? Can they have timed exactly when, and then let's grant them that, right? Could they have predicted how the Fed reacted to the events that happened, right? Within a week or week and a half, I think there was a 1.5 trillion quantitative easing effort, right? A lot of money got flooded into the markets. So prediction game is hard at that time scale. And so what we look at Arta is, is not just predicting, but it's almost like, let's use the entire state of the user and see what can be done given the information we have today to create a better economic outcome, right? And one way to do so is, well, let's look at the concentration risk that this user has, right? Are we efficiently using every bit of risk that they're taking? That's number one. Number two is, are there tax efficiencies that we can gain, right? Like they might have, stocks that are losing money that can be used to harvest losses to lower their tax liabilities, right? That's a much more guaranteed outcome than trying to predict the market 2 to 3 years down the road and hoping that the models hold up, right? And so, oftentimes we look at this space in a much more sort of broader view than just predicting prices. It's more about, there's many levers that we have to create a better economic outcome for our users. And, while price prediction is one of them, there's many, many others that we look at.
Now, our listeners may not be familiar with the term family office. I happen to be, because I worked at a hedge fund and we had a lot of family office clients. But one of the things that a family office usually has that a regular Joe investor does not have is access to what the industry calls alternative assets, right? So maybe talk us through alternative assets and family office very briefly, and then we'll dive back into AI and ML.
Absolutely. Yeah, so family offices can be pretty broad, but as you mentioned, right, the number one characteristic is just access across the board, right? So for instance, on our platform, we have venture capital funds, private equity funds, right? And there's a few more categories there, real estate funds, and then oftentimes
commodities.
Sorry?
Commodities.
Commodity funds, not quite yet, because they fall in a different type of risk spectrum, but we're constantly extending our offerings. So I'm sure at some point we'll add that to the mix as well. But we also offer option strategies to deal with concentrated equity exposures, right? So if someone's portfolio is 50, 60, 70%, composed of single stock, how can we use options markets, A, to potentially generate income, or B, to actually reduce that exposure in meaningful ways, right? Because again, we tend to look at the entirety of member situation before we recommend solutions, but having these actually make a big difference.
And Chirag, for our listeners, maybe give a brief explanation why alternative assets matter at all. Why not just focus on index funds? And because index funds, you have equities, diversified, you've got bond index funds, and so on and so forth.
No, that's a great question. So typically, alternative assets fall somewhere on the high end of the risk spectrum, right? And so if someone's investment horizon is 10 years, 5, 10, 20 years, and let's say you didn't need that money, one way to grow that capital aggressively is by investing in alts, right? They're illiquid, so it makes sense that this is capital that you don't need immediately in the next couple of years. But what you get is typically higher returns than just investing in public markets, but also you can actually get the diversification effect, right? The incentive structure of the funds that are running these is quite different from the equity markets, right? In the equity markets, what you see is companies are incentivized to produce earnings quarter after quarter, right? In the alternative world, the type of assets that these companies are acquiring, there's a longer term view there, right? So purely in terms of diversification, having alts alongside public market actually create a much more diversified and efficient portfolio, right? And two, there potentially could be tax advantages depending on individual circumstances to investing in alts.
So do you folks at Arta, so basically you have a broader basket of assets to play with, right? Because you have access to these alternative assets. So so you use basically the standard portfolio optimization techniques, I imagine, right? So maximize the Sharpe ratio or whatever. So from that perspective, as far as the portfolio composition, portfolio management, asset allocation, is there any machine learning involved, or is it
absolutely,
or is it all
Yeah.
or all just optimization?
Right. So obviously there's problems that can be solved with convex optimization, and that's how they should be solved, right? Because you can guarantee solutions that way. But as I said, we're in the wealth management space, right? So it's not just about higher returns. Alts is actually a good example, right? How do you compose a portfolio with public market investments and alts? Well, you actually have to know about the liquidity constraints that the user has, right? And so that becomes a multi-objective optimization or machine learning problem, right? And the way machine learning comes in here is in a couple of different ways, right? Number one is, how do you analyze the risk of a company, right? There's factor models that you can use, and you can use machine learning to actually derive factors, right? And so we actually use a fairly state-of-the-art model that has thousands of factors that we can decompose the risk of a security into, right? So we know how much e-commerce related risk, just as an example, right? Sector-based risk, subsector-based risk, how much interest rate risk does a company take, right? And not just like broadly interest rate. What's their exposure, based on the 1-year risk-free rate? What's their exposure on the 5-year, 10-year, and so on and so forth, right? So the factor models actually decompose the risk, and then you have a sort of multi-objective problem to solve where like users have these, real-life constraints and needs for the capital that someone might have a kid that's actually going to college, and they need cash flow 5 years down the road, and 5th year you need this much, 6, 7, 8, right? 4-year college, and so then you have to optimize globally using all of those constraints and taking them into account.
So, like you said, you folks are in the wealth management business, right? So, I usually get solicited by all sorts of wealth advisors, right? So they're people, right? So they call you on the phone, and they have personalities and things like that. So you folks are a website that uses AI, but now, of course, with generative AI, you can provide a much more maybe engaging interface. So what is the role? So is this another avenue where generative AI may play a role in the sense that instead of just using a web interface, maybe you have a much more engaging user experience? So, because like I said, traditionally a wealth advisor, you go to this person's office, you kind of tell stories first before you actually go into the business of managing the assets. So how are you gonna replicate kind of that human personality?
Yeah. First of all, we're really excited about this technology. This actually enables us to do things that traditionally have been, as you pointed out, right, have been done by humans, right? But the way we're thinking about it is not that it's a complete human replacement, right? Humans still have value to add in the process. Like financial advisors actually have value to add, right? But what it allows us to do is build this like really state-of-the-art financial reasoning engine, right, if you will. And what I'm talking about is not taking a model like GPT-4 and fine-tuning it, right? Because if you think about this space, right? And I'll go into the details.
Fine-tuning doesn't solve hallucination, which
exactly,
which is a massive problem in wealth management.
Actually, that's an interesting one. I'll get back to that, but let me just make one point about that, right? If you're trying to build a state-of-the-art reasoning engine, if you look at the RLHF process, right, if you go into the details of that process on how humans rate the responses and rank the responses, that whole process incentivizes the model to hedge itself much more aggressively than you would want in a financial advising space, right? And especially if you're building an engine, right, you have to account for cost of inaction, right? It's okay to nuance your answer, but not taking an action has a cost itself, right?
Opportunity cost. Yeah.
Exactly, opportunity cost, right? And so models in this domain need to be built a little bit differently, and potentially, newer ways of actually, generating the training data, right? And this is where I think high quality data sets and domain expertise actually start to come in, right? And the second thing I'll say is much more important to figure out what are the right questions to ask here than to answer a question that seems relevant in this space, right? Like price prediction is a good example, right? I would say for a financial advisor, it's much more important to understand what is the risk tolerance of the user that they're talking to, right? Because you might have the best logical strategy, but if they cannot stomach the ups and downs of the market, they're going to exit at a point which is detrimental to them, right? So it's not just a pure optimization problem. It's understanding where the user is today, and then taking them through that journey where you educate them over time, understanding where they are today, figure out what is the next optimal state for them, right? And so where we think this technology can be incredibly helpful is, using the generative, aspect of the model to almost like you might explain how the markets operate to a creative person in a different way than an analytical person, right? My wife is a physician, and the way I explain financial markets to her are going to be different than someone with your background, right? So this is where this technology can be used to understand the user state, but also then take them through that journey, right?
By the way, Chirag, one of the things that the human brings to the table is you can talk to the human and say, yeah, this is great. All your advice is great. But by the way, do you happen to know a good X? X could be an accountant or real estate agent or whatever, right? So they bring a network and
Yes,
things like that, right? So
absolutely.
more than just the actual wealth management. And I imagine that a digital, an actual family office actually does all of these
Absolutely.
other things as well, right?
Yes, it's cross coordination and all of
Yeah.
that, right? And so we're building all these layers in a way where that cross coordination is actually easier and easier over time, right? And so what the way we think about it is like, let's start leveraging technology to make their lives easier. And over time, use the 80-20 rule. What are the things that can be automated?
With a single logon, maybe you can have a better, broader, more holistic picture of what you're doing, right? So
Exactly. But let me come back to one point you made, hallucinations and it being a problem, right? Actually, in this space, it can be actually used to constructive means, right? And one example of this is, one way to, let's go back to our price prediction problems, right? And we certainly have, the history of prices of how the markets performed over the last 10, 20 years, right? One way to think about them is it's the ground truth. Another way to think about it, and this is how I think about it, is it's one sample from a distribution of outcomes that could have happened, right? And so the key here is not to over-index on that one sample, but the key here is this attempt to learn the distribution that it came from, right? So a good example, again, is 2016 election. I don't know if anyone could have predicted it might have gone the Democratic way or the Republican way, right? It was pretty close. And in fact, most experts got it wrong, right? And so the question is, well, what if another trajectory would have happened, right? And you can use the generative aspect of the model, which also leads to hallucinations, to actually generate synthetic data that you can actually use to test the robustness of your models, right? Of the approaches that you're taking. So in some ways, if used creatively, these things can actually make things much more robust.
So it can be used, in essence, you can use the hallucination to do some sort of what if scenario
Precisely.
Analysis.
Precisely.
Yeah.
But doing it in a much more nuanced way, right? Like there's always, Monte Carlo simulations that financial advisors do, but this is at much, much larger scale, much more nuanced where you have the distribution. Effectively, that's what LLMs are doing, right? Is this It's basically mapping distributions across the inputs and outputs. And so you get a much, much deeper view into how to sample from that distribution.
I know you attended and enjoyed the first AI conference in San Francisco. Thank you.
It was wonderful.
And as you notice, one of the main topics at this conference is the use of domain-specific data. I guess the term is retrieval, augmented generation, or grounded generation. So what's your take of those methods in as far as you're concerned in wealth management and finance?
Yeah, I think they're very valuable. I mean, internally, like here are the lessons we've learned so far, right? Which is it's better to use many, many different models because different models are suited for different types of tasks rather than just relying on one big model, right? From a resource efficiency point of view, from being able to evaluate what these models are doing and scope them well. But in terms of like where these technologies need to be used, the way I think about it is, well, first of all, what problem are you trying to solve, right? And the problem that you're trying to solve, does it, can you evaluate whether an answer is right or wrong? Or is it open-ended where humans need to get involved and sort of judge the response, right? If it's well constrained, right? An example of this might be, I want to take an article, extract the information about which companies are being talked about in this article, right? And if you're using an LLM to extract that information, it's pretty easy to say, yes, did it get it right or wrong, right? I think this is where RAG and related approaches are very, very useful, right? Where the output space is very well constrained. And you can have systematic evaluations of whether this is right or wrong, given the existing systems, right? Where it's not so clear is the generative aspect of the model, right? And here's the example I use, right? What if you wanted the model to create, a character based on, Einstein, Shakespeare, Darth Vader, and create a Bond movie out of that character situated in the 16th century? Like, does anyone know what the right response should look like? No, right? But that actually can lead to a very magical experience, right? And so this is sort of how like we tend to ask the questions like, what are we looking for? Is it a magical experience in service to something specific? Like it might be educating the user, right? It might be making a point about what financial markets are doing, right? But the former actually drastically simplifies existing use cases. That's how I think about it, right? RAG-based approaches, right? It's not that you're solving a different problem, but it's that your solution to an existing problem is drastically simpler than it used to be.
So now, so the question, I guess, the more specific question is, are you folks using RAG?
Absolutely.
Okay.
Yeah, absolutely. And it's not across the board because for certain use cases it makes sense to do so, and for certain other ones it might not, right? But certainly to keep the model well-grounded, to make sure that we have enough validations in place. Yeah, those types of approaches have been very, very critical for us.
So what are some of the key problems that you are working on right now? So you earlier on you mentioned, and obviously this should be clear to anyone who works in AI or ML, but data quality and data is obviously the most impactful thing. But so what are the other key knobs that you're trying to refine and improve and push?
Yeah, as you mentioned, right, data quality is paramount. The other thing that is quite subtle in this space, which is the time aspect of when the data is collected, right? So I'll give you an example. GPT-4, right? If you take GPT-4, generate some insights on some historical data, and then show that that backtest is doing really well, I would tell you that there's absolute leakage of information going on in that study, right? Because think about the data sets that GPT-4 or any other LLM was trained on, right? It's typically the pile and a whole bunch of news sources, a whole bunch of regulatory filings, right? So the model already has access to this information, even if you use it on historical data set to transform it. Like the usage of the word alphabet in the embedding space actually means something different to a model that had access to that information than had you limited the access to that information, say pre-2006 or 7 or whatever that name change happened, right? So that's one thing we're critically focused on, is building time is a first-class citizen in our infrastructure, right? And even if our researchers wanted to, they couldn't violate time boundaries. So that's number one, just to make sure that we're doing these evaluations in the most appropriate settings. So that's important. Number two, as I already mentioned, I think the key here is building the state-of-the-art financial reasoning engine, right? And that takes many forms. So one of the immediate ones that we're working on, and we'll launch pretty soon, is what we're calling the thematic service, which is effectively the user can come in and take an unstructured, enter an unstructured query like e-commerce companies, right, for instance. And in the background, we use a bunch of LLMs to be able to identify, okay, which companies actually map to this theme, right? And not only do we identify that, and this is where RAG-based approaches are very useful because we ground it in the actual high-quality data sources that we have, right? And we can put validations in place to ensure that these recommendations are appropriate. But not only do we say that these might map to the theme, we also actually mention reasons why it might not map to them, right? So it's keeping the model robust. It's not just ensuring that there's robustness in the model inferences, right? But over time, you can imagine unstructured queries coming from the user. Hey, what should I be looking at next? My financial state, right? And the reasoning engine should be able to say, okay, I see your state. Or maybe the next thing you should be doing is invest in alternative assets, right? Because it's going to create more diversity. And here's how it might impact your forward trajectory. Or if it's an ultra high net worth individual, it might be that, hey, you should be actually looking at an insurance policy, right? Because you might be hitting up the estate tax limits, right? And again, these can have a very, very significant impact on the final economic outcome for that user. That has nothing to do with alpha generation. So these are the types of problems that we're working to solve with LLMs. But doing so in a way where, in every place where we use LLMs, there's human oversight. So capital is not being invested anywhere without actual humans who have domain expertise in this space are looking at, what the LLMs did. We have a very strong audit trail. So we can actually go through the reasoning that the model made to get to the final conclusion. And a human, domain expert can look at that reasoning, chain of reasoning, and say, okay, this is where it is, and so they can then, either approve it or say, okay, I find that this is not accurate, and so make changes to that. But we see this way of developing it as much more responsible, than just using one model and enabling new use cases.
So feel free to decline answering this question because I know you finance people are secretive. But based on your response just now,
Sure.
I'm interpreting that you folks are developing your own LLMs as well, not just relying on the open source LLMs or the public proprietary LLMs. True or false?
True. I don't mind admitting that, but it's true.
Yeah. And
Yeah.
so then, so this LLM you folks will train from scratch, very, very specifically tied to your kind of domain data, but also to your application.
Absolutely.
Yeah, interesting. And so then the financial reasoning engine will come from this proprietary LLM, not from some fine-tuned open source LLM.
As I said, I think we constantly look at, the space is moving so fast, and Ben, you know this more than anyone else, right? Is whatever I'm saying today, in 3 months, the landscape can be completely upside down because there's a new development, but we're constantly watching. And to be honest with you, we'll use, closed source, open source models where we think they make sense, right? This certainly, these models actually have a lot of breadth that is actually useful,
a mixture of experts, right? So
exactly, like none of that has changed, right? Diversity of models and, using the best of every model and actually extracting the, insights from across the board actually makes sense. So it's not a either or, it's a more diversified approach to doing it. It's just that certain use cases require a model to be tailored differently, right? And the specific example, like I gave you with RLHF, right? It's for certain use cases, it's actually the right thing to do, right? If you think about it, if it's a general chatbot, you don't want to be making strong claims, right? That's the right behavior for that context.
feel free to insult the following LLM, Bloomberg GPT. What's your take? Sorry, Gideon man.
No, actually, I don't.
No, that's have
It's,
you?
it's not a bad. No, it's not a bad model by any means.
Is it even open? It's not actually available, so it's hard to
Yeah,
tell.
it's hard to tell.
Yeah, yeah.
But I certainly do appreciate the details that they did share, right? It was, obviously more details can be shared and the models can be open sourced.
Yeah.
But some of the insights there were quite interesting, right? One of the insights was, it matters which encoder you like, which tokenizer you use, right? And the one thing that they've shown to a degree is domain-specific data actually shows improvements, right? And so while we don't have access to the model, I think the pointers are valuable. That's all I'll say about that.
So the folks at Nscale have published several blog posts about RAG and the experiments they've done. So as many people know, RAG is actually has many kind of factors involved, many knobs you can turn to do your experiment.
Right.
So they've shared a few things. One is that actually the chunking strategy matters more than the embedding model, and so on and so forth. But one of the interesting learnings across the RAG space is actually the more you know about your data, the better the RAG is. So for example, if all you know is some metadata, then it actually helps, right? Because maybe the metadata has to do with location or time. And the question is time or location specific. And then, so now the speculation, Chirag, is that even more knowledge about your data to the point that maybe you have a knowledge graph.
Right.
That's going to be really helpful to your RAG system. And some people have proved this out, at least in the SQL space, right? So if you take a relational database, you're going to have a text to SQL model. But if you have a knowledge graph on top of that in the relational database, the text to SQL model is much better. So long-winded question. Are you folks investigating knowledge graphs?
I won't comment specifically about knowledge graphs, but the problem you're pointing out is actually resonating, and I'll give you a very concrete example of this, right? Is if you look at companies and how they evolve their businesses over time. If you look at Kodak, right, at some point it was cameras, and then it was something else, right? It's constantly changing. And if we're simply using RAG, to look at any publication related to that company, and if that time aspect is missing, then the inferences will come up with will be inaccurate, right? It might be a technology company 10 years ago, but now it's like a entertainment company. Look at Netflix, right? Their business model has certainly evolved, right? And so certainly that time aspect is something that we treat very carefully, right? And how do you actually ensure that documents are appropriately ranked, right, when you do the retrieval? Because if you have a large corpus on every retrieval request, right, then you need effectively a good way to rank these documents. And that's where the domain-specific data comes into play, time being one of them. But I can imagine, knowledge graph adding more to that ranking function, right, effectively. So certainly, I think that could be useful.
So let's close with a few rapid fire questions.
Sure.
First, high frequency trading. Is it really just front running? True or false?
False.
All right. So give us some justification.
So the reason I say it's not front running, right? Because it's front running if only you're the only participant in the market that knows something. It's not front running if you are the one who can react to the publicly available information in a more efficient way, right? So that's the difference, right? Front running is you have some knowledge that others don't. But high frequency trading is like you're looking at everything that everyone else is looking at, right?
All right. Second, generative AI as a tool for basically creating an interface for wealth management that mimics almost like a human advisor. Is that going to be happening in the next 5 to 10 years or even sooner?
Answer to the last question is yes. I think the probability is in favor of that happening. But I don't necessarily think it's one model that will own the end-to-end chain of events that need to happen to support that type of a use case. I think it's going to be a collection of models, some very focused on getting the financial reasoning right, some focus on doing absolute, best-in-class retrieval to support that reasoning, right? And so it's going to be a mixture of models that will enable that. But again, as I said earlier.
But then, so this human-like generative AI wealth advisor can also help you with, as you pointed out, with this coordination problem, because I'm assuming the coordination problem is just a RAG lookup, right? So tell me about the competent real estate people or accountants in this area that might be helpful for me. So surely the RAG system can.
Sorry, is the statement that
So generative AI can really closely mimic what a human wealth advisor provides you now?
I think the current state of generative models are really, really good at mimicking what experts can sound like. It is yet to be proven whether their reasoning, the ability to reason through an answer and be able to provide evidence and artifacts of why they came up with that reasoning, is still yet to be done. So RAG could be useful in providing those artifacts and supporting if you will, audit trail, right? There's a reason why use cases that are currently popping up in generative AI in finance are not client facing today, right? Because obviously it's the responsible thing to do.
Dangerous.
Don't just point this new thing at retail investors or investors at scale. But where I see this happening, this technology being used is processes like KYC, right? Custody and clearing businesses could use this technology, right? It's the middle office and the back office that are going to take the most advantage of this technology. And I think 5 to 10 years for sure. I think this technology will be used for sure in advisement, right? But there might still be human oversight.
Yeah. So
the other thing, Ben, I'll mention,
if we map this back
Yeah.
Chirag, to time scale, right? So let's say right now, it is basically 95% human with 5% generative AI. Human is the main interface, but human is using some AI tool in the background, but 95% of the interface is with the human. In 5 years, what is the breakdown?
that one is hard to predict. Certainly it's going to be greater than what it is today. Certainly it's going to be greater, right? And it's rightly so, right? Like technology has done this for decades, right? We've seen humans take on more and more abstract work, more and more work that automation, automation is the right way to increase productivity, right?
And maybe the right way to frame this, Chirag, is like what you folks are doing, which is basically democratizing a family office.
Right.
But in order to do that, that means that every single human wealth advisor will need to be able to take on 100x more
Exactly.
clients, right? So
That's the hope, right? Because they are adding value. The question is, how can we increase their reach? How can we use technology so that they're not wasting time doing the mundane work a model can easily do, right? That's absolutely.
And so what will happen is that the family office concept, in order to roll that out at scale,
right,
really requires this AI tool, right?
That's right.
Yeah. And so then any kind of development on the price forecasting, price prediction dimension, because that's what the general public is most fascinated about, right? So when will Chairman Powell cut rates, right? So
so that's a you asked a great question and you kind of answered your own question.
Right.
Because think about the Fed, right? They have the highest quality information available to them.
Yeah.
Look at what happened to the inflation forecasts,
Right.
Even the entity that has the highest quality data, it's difficult to predict what will happen. So our focus is a lot more on, well, we already know where we are, the state we're in, right? And there's a lot we can do with it. And so price predictions are, while important, the variance band on these are extremely, extremely wide. And so you discount, whatever the predictors are telling you. The other thing is, Ben, there's n different ways these backtests can misfire, right? Is even though genuinely you might have found an alpha today using generative models that look good, and let's say you have no leakage of information, but you still have to account for the fact that other people have the same tool now. So they are also doing the same things you're doing, right? Potentially. And so how do you account for that in your backtest, right? So there's many subtleties here that we certainly think about it day in, day out. We're excited about what we're doing here. But we're looking at this problem in a much broader way than just simply price predictions.
So,
And the
Chirag,
other thing, Ben, to actually drive home the point, is you and I could have the same price prediction. Let's say we both own a stock. We could have the same price prediction, but let's say the stock you hold has a very low cost basis. So if you were to sell it today, because let's say our prediction says it's going to go down, but if you were to sell it today, you're going to get a massive tax bill at the end of the year. So you won't sell. But I, on the other hand, my cost basis is high. I will sell it today because my prediction says it's going to go down. I'll make money from it. So we both can have the same prediction, yet we're going to take different actions based on current state.
right. And this is the kind of thing that individual investor just is kind of, I guess, outgunned, basically. I mean, I think a lot of people got carried away with the GameStop story that retail investors are now kind of eating the lunch of
Yeah.
sophisticated investors. But in reality, I think that's much more of an anomaly, really.
That's right. And like in the factor investing space, right now there's a new factor called meme stock factor, right? And so markets are accounting for it, right? And so yeah, I think in the end, unless you're a professional investor, like dabbling into intraday trading or very short-term price predictions, those are high-risk endeavors. Not saying that can't be done. Certainly there are hedge funds that are focused on that, right? But they're going to run into scale issues. They're going to run into the issue of constantly finding that alpha that works.
So, Chirag, in closing, so for ML people and AI people and data engineers listening to this podcast, why should they take a look at Arta as a employer?
Several reasons. Number one is our vision is to democratize this access and the insights that we're going to generate on the platform, right? Access via all the different verticals of finance that we give access to our members, right? Which is.
But bottom line, are you guys doing interesting shit?
Sorry, you got cut off there, Ben.
Bottom line, are you guys doing interesting shit?
Oh, absolutely. We're knee deep in LLMs, RAG, all of these technologies. But I think we're taking a very cautious route to productionizing these things.
And it's also real world problems where you got to get it right. You got to get it right.
We got to get it right. And it's the same thing as, self-driving cars. They have to be 10x better than the human drivers for them to be, accepted at scale. We kind of see the same thing here, right? Which is like, it's not good enough if it's just 20-30% better than what a human would do in these situations. It has to be that much more better, right? And the bar for quality is pretty high. And we think that's the responsible thing to do for our users. So, a lot of the other thing is we sit at the intersection of, quantitative finance, machine learning. These are some very interesting areas. So we sit at the intersection of very, very interesting technologies that come together to build this product at scale, right? Which is generally not the case. So if you want to learn about financial markets, if you want to start to become a domain expert there, and if you want to learn about machine learning and get better at it, Arta is a great place.
Yeah, and to our listeners who aren't familiar with quantitative finance or the financial or this kind of much more the investment side of finance, one thing I would say is that this is a space that moves fast because their priority is obviously to do well by their clients. So they will use whatever technology, whatever solutions are out there. They always are looking for the most bleeding edge solutions because that's what they need to do in order to stay ahead of the game.
Absolutely.
And so if you want to work in a place where You're constantly being challenged because let's not downplay it. This stuff is hard. Finance is hard. Probably one of the harder places to do ML and AI. But at the same time, you're still using a lot of the things you read about. I think this is a great fit.
Absolutely.
Yeah. And with that, thank you, Chirag.
Thank you, Ben. It's great chatting with you today.